Welcome. We are doing KASNEB past paper question, CPA, financial reporting and analysis, November 2016, question 2. The question is on published financial statement. Published financial statement. Let us go through the question. The following trial balance relates to Dodoma Limited as at 30th April 2016. Revenue, inventory, raw materials purchased, production cost, distribution cost, administrative expenses, lease rental paid, property, plant and equipment. We have at cost, and then accumulated depreciation, that is 1st May 2015, income tax account, deferred tax account, trade receivable, cash and cash equivalents, trade payables, ordinary share capital, ordinary dividend paid, and retained earnings. Then we have additional information. On 20th April 2016, Dodoma Limited agreed with customer to supply goods in the month of June 2016. The customer paid a deposit of shillings 5 million, which Dodoma Limited credited to its revenue account. Dodoma Limited has not made any adjustment to inventory on account of the deposit. Number 2, a stocktake was done on 30th April 2016 that showed closing inventory at cost of shillings 40 million. However, there were some damaged goods with a cost of shillings 4 million that required to be repaired at a cost of shillings 400,000 and then sold for shillings 3,500,000. On 1st May 2015, Dodoma Limited entered into a two-leasing contract as explained below. Contract A. The contract was to lease motor vehicles for a 2-year period. The estimated useful life of the vehicle at the start of the lease was 5 years. It was the responsibility of the lessor to repair and insure the vehicles. The lease stated that Dodoma Limited should pay a deposit of 600,000 at the start of the lease, followed by monthly payment of shillings 200,000 in arrears. The lease rental figure for the year ended 30th April 2016 includes shillings 3 million in respect of this lease. The vehicles were to be used by office staff. Contract B. The contract was to lease a number of machines. The lease was for a 4-year period, which was the estimated useful life of the machines. Dodoma Limited was required to repair and insure the machines, which would have no residual value at the end of the lease. The lease rentals were set at shillings 10 million every 6 months payable in advance. The lease rental figure for the year includes shillings 20 million in respect of this lease. The rate of interest implicit in this lease was 5% per 6 months period. The fair value of the machines at inception of the lease was estimated at shillings 70 million. Number 4. Property, plant and equipment include, we have cost, shillings in thousand, accumulated depreciation, shillings in thousand. Property, 90, that's 90,000, 90 million. Accumulated depreciation, 5 million. Plant and equipment, 90 million. Accumulated depreciation, 30 million. The total is 180 million on cost, and the accumulated depreciation total is 35 million. The plant and equipment is being depreciated on a straight line basis at a rate of 25% per annum. The depreciable element of the property has an allocated carrying value of shillings 50 million and is being depreciated on a straight line basis over 50 years from the date of original purchase. On 1st May 2015, the directors of Dodoma Limited revalued this property for the first time. The property had an estimated market value of shillings 100 million as at 1st May 2015. It is further estimated that shillings 54 million of this value relate to the depreciable element. The directors have decided not to make a transfer of excess depreciation on the revalued asset to retained earnings. Depreciation on all property, plant, and equipment should be charged to cost of sales. Number 5. The estimated income tax liability for the year ended 30th April 2016 is shillings 5 million. The balance on the income tax account in the trial balance is the residual of the previous year after making the payment for that year. At number 6, a transfer of shillings 600,000 needs to be made to the deferred tax account for the period. Trade receivable includes an amount of shillings 10 million owed by a customer who experienced cash flow problems prior to the year end. Dodoma Limited agreed to accept a payment of shillings 8 million in full and final settlement of the debt and to defer the payment until April 2017. The expected return on sum invested for 1 year is 10%. You are required to you are required to prepare statement of comprehensive income for the year ended 30th April 2016, and B, statement of financial position as at 30th April 2016. Therefore, let us first start, we work out all the additional information. Then after that, we are going now to answer the question, prepare the statement of comprehensive income, and then prepare the statement of financial position. Number one, let us first go to the additional information. Number one, on 20th April 2016, Dodoma Limited agreed with a customer to supply goods in the month of June 2016. So these goods are being supplied on June 2016, but the year is ending on 20th April 2016. Therefore, this supply does not relate to the current year or to the current accounting period. But the customer paid a deposit of shillings 5 million, which Dodoma Limited credited to its revenue account. This 5 million should not be credited to the revenue account because that deposit does not relate to supply of that current period. It does not relate to supply of that current period. It relates to supply of the next current period, which will start on 1st May 2016. So it means that our first working will be to take revenue. Working number one, we take revenue that is reported in the revenue as per the trial balance. We check how much is the revenue as per the trial balance. The revenue is 315 million. We deduct 5 million. 315 we deduct 5 million and we are getting 310 million. This is the figure we are going to report as our revenue, and then this one will go to our statement of financial position. To go to our statement of financial position because it is an earned revenue. We go to the additional information number 2. A stock take was done on 30th April 2016 that showed closing inventory at cost of shillings 40 million. However, there was some damaged good with a cost of 4 million that required to be repaired at a cost of 400,000 and then sold for shillings 3,500,000. And this question is testing your understanding of International Accounting Standard 2, where it says that inventory is measured at the ROA of cost or the net realizable value. So in this part, we are going to find the cost of these damaged goods is 4 million. That is the cost of the damaged good. And then this damaged good can be sold for 3,500,000 after being repaired for 400,000. Therefore, we are going to find the net realizable value. We compare it with the cost, and whichever is lower, we are going to take that as a value of the closing inventory of these damaged goods. So working 2, the balance of the stock at the end of the year is 40 million. We raise the damaged stock because the cost of the damaged stock is 4 million. That is the cost of the damaged stock. Because 4 million, if you add the cost to repair those damaged stock, you get 4.4 million. But if you find the net realizable value, because that stock can be sold for 3.5 million, that is 3,500,000, plus the cost, obvious, plus the cost of repair, you're going to get that this one is 3,900,000. Therefore, this net realizable value is lower than the cost of the damaged stock. So we are going to replace this cost of the damaged stock with the net realizable value. This is the net realizable value, which now we are getting as 39,900,000. Then we go to the additional note number 3. On 1st May 2015, Dodoma Limited entered into 2 leasing contracts as explained below. Let me first clarify that about the leases. Currently, that is from the year of 2019, January 2019, the leases are being accounted for using the International Financial Reporting 16, that is IFR 16. But for the previous years, that is from December 2018, That's for the previous year from December 2019. You go backward. The RIS was being accounted for under the IS 17, that is International Accounting Standard 17. Therefore, this is a question of 2016, and therefore, the accounting standard that is being tested here was the International Accounting Standard 17. But from January 2019, listen clearly, from January 2019, the IFR 16 superseded IFR 16 superseded the IS 17. IFR 16 IFRS 16 superseded the IAS 17. Therefore, this list we are going to account it for using the IAS 17 because this is a question of 2016. This is a question of 2016. But when we come to the questions of 2019, that is from January 2019, we will now be using the IFRS 16. Understood? So let us go through the contract A. The contract was to lease motor vehicle for a 2-year period. The estimated useful life of the vehicle at the start of the lease was 5 years. Therefore, obvious under the IAS 17, obvious this is an operating lease. Under the IAS 17, this is an operating lease. So, being an operating lease, it was the responsibility of the seller to repair to repair and insure the vehicle. The lease stated that Dodoma Limited should pay a deposit of 600,000 at the start of the lease, followed by monthly payment of 200,000 in arrears. The lease rental figure for the year ended 30th April 2016 included shillings 3 million in respect of this lease. The vehicle were to be used by office. The vehicle were to be used by office staff. So, if the vehicle was to be used by office staff, then it therefore means that the interest here, the interest that we are going to calculate here, is going to be classified under the distribution. It's going to be classified as the distribution expense because the vehicle were being used by office staff. Therefore, we go to the rental that were paid. We are told there were 3 million. There were 3 million. Those were the rental that were paid, 3 million. Then the monthly payment are 200,000. The monthly payment are 200,000. Therefore, the monthly payment which you are going to take into the income statement are 200,000. So that one we multiply by 200,000. We multiply by 12 because that now is the interest. So we are getting 2,400. Remember the figures are in thousand. Then we have the advance payment was 600. That was the deposit. The deposit was 600,000. So if we go to our administrative expenses, we now go to the administrative expenses. We can also classify the we have said that this interest will be classified as a distribution cost, but we can also classify it as an administrative expenses because it is being used by the office staff. It is being used by the office staff. The reason we are changing from the distribution to the administrative is because we are not told that whether these motor vehicles are being used they are being used to distribute the good. We are just told that the motor vehicle are being used by the office staff. Therefore, we can classify that as we can classify the interest here as an administrative expense. Therefore, we go to the administrative expense here. Administrative expense as per the trial balance are 22 million, 22 million. That's the administrative expense which were paid. Then the administrative expense that we are going to take to the income statement are 22 million, 22 million. This one here, we add that interest. We add that interest of 2,400,000, 2,400,000. Then there is that was paid. For total, it is 3 million. We are still doing there is contract A. We have been told. Let us go to that additional information. We have been told that there is rental figure for the year ended 30th April 20 included shillings 3 million in respect of this risk. That is why we are putting 3 million here. So we balance this account 25 million. This one is 22, 20, 24, 400, and the balancing figure here, that is the advance payment or the deposit, is the 600,000. Therefore, we are done with that lease. We said that's an operating lease. We are done with that lease. We are done with that lease. We are done with that lease. We have calculated the figure which you are going to take to the income statement, and then we have classified that interest under the administrative expense because we are told it is for official use. I said we are told it is for official staff, but we are not told whether the motor vehicle are being used for distribution of the company goods, or we have been told they're being used by the official staff. Maybe they were given to the official staff to be taking them to work. That's why we are classifying that interest as under the administrative expenses. Then we go to the risk in contract B. Contract B. The contract was to lease a number of machines. The lease was for a 4-year period, which was the estimated useful life of the machines. Dodoma Limited was required to repair and insure the machines, which would have no residual value at the end of the lease. Therefore, this is finance lease under the International Accounting Standard 17. The lease rental were set at shillings 10 million every 6 months payable in advance. The lease rental figure, you have to note very clearly when the lease rental are being paid in advance and when they are being paid in arrears, because the lease amortization schedule for when the lease rental are being paid in advance and when they are being paid in arrears is different. It is so different. Therefore, you have to note here when the lease rental are being paid in advance and when they are being paid in arrears. The lease rental figure for the year includes shillings 20 million in respect of this lease. The rate of interest increase in this lease was 5% per 6 months. The fair value of the machine at inception of the lease was estimated as shillings 70 million. Therefore, we go to that lease. The lease liability, the lease liability, we've been told it is 70 million. Our calculation are in thousand. The leased machine asset 70 is 70 million. We can calculate the depreciation of the leased machine, which is 70 million. 70 million. We divide by the let us check. The lease was for a 4-year period, which was the estimated useful life of the machine. So we divide by the useful life or the useful life of the machine, or the useful life of the machine, or the lease period. Remember, if you are given the lease period and the useful life of the machine, you calculate your depreciation on the row of either the lease period or the useful life of the machine. But in this case, the lease period and the useful life of the machine is equal. It is 4 years. So we divide by 4. We divide by 4 years, which you are going to get the depreciation per year is 17,500,000. 17,500,000. Therefore, the book value of that machine at the end of the year will be 70,000. We deduct the depreciation, which is 17,500,000, which you are going to get 52,500,000. 52,500,000. Then we have our lease liability amortization schedule. Our lease amortization schedule. We start with the balance brought down. That is the 70 million. That is the lease liability, 70 million. Then we deduct the installment paid, because the installment are being paid in advance. This is where I was telling you there is a difference between when the rental are being paid in advance and when they are being paid in arrears. If they are being paid in arrears, we could not first deduct this 10 million. We could just take 70 million, then we multiply by the interest rate. But now the lease rental are being paid in advance, and therefore that's why we are first deducting this 10 million, because this installment was paid before the expiration of any period. Therefore, there was no interest calculated on this first installment. So we get a figure we call a subtotal, which is 60 million. Get 60 million. Then we multiply by 5% to get the interest. So we are getting 3 million. Therefore, the balance carried down, it is this subtotal we earned this interest, which is 63 billion. That is for the period from November 2015, from November 2015 to that 1st March 2016, because these rentals are being paid on half yearly. We have been told they are being paid on half yearly. Let us check that one. They are being paid per 6 months. That is half yearly. They're being paid per 6 months. So that now we go from April 2016. We have the balance brought down is 63 million. We deduct the installment paid, that is 20. The installment paid in advance, that is 10 million. We get 53 million. We calculate the interest on this 53 million, which is 2,650,000. So the balance carried down, now it is this one plus this. It is 55,650. Then we go to the period from November 2016 to that's 1st March 2017. The balance brought down is 55,650. We deduct 10 million. You're getting 45,650. The 5% on 45,650 is how much? It is 2,282,500, and therefore the balance carried down is 47. Now it is this plus this, you're getting 47,932.5. The balance brought down is now 47,932.5. We deduct 10 million. We are getting that 7,932.5. 5% on this is 1,896.6, and the balance carried down is 39,829.1. Therefore, the finance cost for the whole year, the finance cost is just for that year is just this 3 million we add 2,650,000. So that one has no charge. Finance cost is 3 million. We earned 3 million. We add 650. We earned 650. 2,650,000. And if we do that, we are getting the total finance cost for the whole year is 5,650,000. 5,650,000. 5,650,000. Then the risk liability is just this one. The balance cut down 55,650. Therefore, we are done. We are done with that additional information. We are done with that additional information number 3. Then we go to the additional information number 4. Property, plant and equipment include property at cost is 90 million. Accumulated depreciation is 5 million. Plant and equipment 90 million. Accumulated depreciation 30 million. The plant and equipment is being depreciated on a straight line basis at a rate of 25% per annum. The depreciable element of property has an allocated carrying value of shillings 50 million. Therefore, we can calculate the depreciation on plant and equipment. The depreciation on plant and equipment in our working note number 5, which is 25 million, which is 25%. That is 25 over 100. We multiply by the cost, which is 90 million. And if we do that, we are getting the depreciation as 22,500,000. Then we go to the depreciation of property, the depreciation of properties. Let us finish reading that additional information. The depreciable element of the property has an allocated carrying value of shillings 50 million and is being depreciated on a straight line basis over 50 years from the date of original purchase. On 1st May 2015, this is now the beginning of the year, the directors of Dodoma Limited revalued this property for the first time. The property had an estimated market value of shillings 100 million as at 1st May 2015. It is further estimated that shillings 54 million of this value relate to the depreciable element. Therefore, we are going to depreciate this 54 million in regard to the property. This is the depreciable element. 54 million. 54 million. The directors have decided not to make a transfer of excess depreciation on the revalued asset to retained earnings. Therefore, we are not going to take any excess depreciation of this depreciable element to the retained earnings. So, the depreciation of property now is going to be 54 million. 54 million we divide by the useful life of 50 years, which you are getting 1,080,000. 1,080,000. We are done with that working. Then we can go to we can calculate the cost of sale at this juncture. We can calculate the cost of sale at this juncture. The cost of sale is composed of the opening inventory. How much is the opening inventory from the trial balance? The opening inventory is 32 million. Then the raw material purchased is 150 million. The production cost is 60 million. So all of that are the components of all of those are components of the cost of sale. I will take the opening inventory, that's 2 million. Raw material purchased, 150 million. Production cost, 60 million. Depreciation of plant and equipment, which you have done in this working 5. Depreciation of plant and equipment, 22,500,000. 2,500,000. Depreciation of property, 1,080,000. Remember the depreciation, we have been told all these depreciation are being calculated as cost of sale. Depreciation on all property, plant, and equipment should be charged to cost of sales. That's why we are putting this depreciation here. But even if the question was silent, the depreciation is usually expensed in the cost of sale. Then we go to the depreciation of the leased machines. Depreciation of the leased machine is 17,500,000. Depreciation of the leased machine, 17,500,000. 17,500,000. Then we finally less the closing inventory. The closing inventory, which we have done in our working note number 2, it is 39,900. 39,900. And if we do this computation, we are getting 243,180 million. 243,180 million. Then we can go to the working note number 7 of the deferred tax. We go to the additional information, we check what they have said about the deferred tax. The estimated income tax liability for the year ended, that is April 2016, is shillings 5 million. The balance of the income tax account that will balance is the residual of the previous year after making the payment for that year. A transfer of shillings 600,000 need to be made to the deferred tax account for the period. So we can check the balance breakdown of the deferred tax. The deferred tax account, the balance breakdown is 7,200,000, and then the income tax account is 400. The income tax account is 400,000. Is 400,000, is this an under provision or an over provision of the previous year tax? Is this an under provision or over provision? If it is on the debit side, obvious it is an under provision. This is an under provision of the previous year tax. But if it could be on the credit side, it could be and over provision. So, do you know how to calculate the income tax? The income tax expense for, for the period is usually calculated as the estimated tax. You add the transfer to the deferred tax, you add the transfer to the deferred tax, or if it was a transfer from the deferred tax, you either add the transfer to the deferred tax or less the transfer from the deferred tax, and then you less the under provision of the previous year tax or add the over provision of the previous year's tax. Let us do that practically. Uh, the balance brought down the balance brought down of this of the deferred tax is 7,200,000. Then the transfer from the transfer to the deferred tax, we have been told it is 600,000. The transfer to the deferred tax, therefore the deferred tax will increase to 7,800,000. So the balance carried down of the deferred tax is 7,800,000. We balance that account, 7,800,000. Then we go to the income tax. There's a challenge here. This is not supposed to be combined, but we can still work it out that way. So this is the income tax. Our figures are in Kenyan shillings, that is shillings in thousand. Let me delete this one. Yeah, now it is okay. So we have the income, the estimated tax. The estimated tax we have been told it is we have been told that the estimated tax is 5 million. That is 500,000. Our figures are in thousand. And then the transfer to the deferred tax is 600,000. Is 600,000. That is 600. And then previous year provision we deducted is 400,000. 400,000. If we do this, we are getting 5,200,000 as our tax expense. We are getting that as our tax expense. And I think I think at this juncture we can work out the statement of comprehensive income. We can work out the statement of, we can first finish the additional information. Here we have the property, plant and equipment schedule. The cost of property is 90 million. That is the cost. The cost of plant and equipment is 90 million. 90 million also. Therefore, the total cost is 180 million. The accumulated depreciation at the beginning is 5. It's 5 million. This one is 30 million. So the total accumulated depreciation is that 5 million. That 5 million. And if we do this, the book value, that is at the beginning of the year, that is on 1st May 2015, this one is 85 million. This one is 60 million. And the total is 145 million. Then the fair value of property at 1st May 2015, we have been told it was revalued to 100 million. 100 million. Then the depreciation charge is 1 million and 80. We have calculated this in our working note number 5. The fair value of the plant and equipment is 60 million. 60 million. The depreciation charge is 22 million 500,000. 22 million 500,000. So the total is 160 million, and this one is 23 580. If we deduct this, we get the book value at the end of the year is 98 920, and for the plant and equipment is 37 500, and the total is 136 420. 136 420. Then we have the revaluation. The revaluation gain of property. The revaluation gain of property. So we're just going to take 100 million. 100 million. We deduct the book value at 1st May 2015. This was the revaluation. This is the revaluation at 1st May 2015. We deduct the book value at 1st May 2015 to get the revaluation gain. We deduct 85 million, and if we do this, we are getting the revaluation gain as 15 million. Then we have the trade receivable. The trade receivable, as per the trial balance, trade receivable as per the trial balance, we can check the trial balance. The trade receivable is 50 million. The trade receivable is 50 million. Then there's the discount allowed. We have the discount allowed. The discount allowed for in our additional information number 7. I've been told that the trade receivable includes an amount of shillings 10 million owed by a customer who experienced cash flow problem prior to the year end. So Dodoma Limited agreed to accept a payment of shillings 8 million in full at final settlement of the debt and to defer the payment until April 2017. The expected return on sum invested for 1 year is 10%. So therefore it means that there's a discount allowed of 2 million. So in our trade receivable, the discount allowed, we can calculate is 10 million. We deduct 8 million, we get the discount allowed of 2 million. Therefore, the balance carried down of the trade receivable is 48 million. The total we are getting 50 million. We balance this account 50 million. Therefore, the interest receivable on the deferred trade receivable is the interest receivable is 10%, that is 10 of 100. We multiply by 8. We multiply by 8 million. And if we do this, we are getting the interest receivable of 800,000. The interest receivable of 800,000. We are done with the additional information, and we can now go to the statement of comprehensive income. Revenue, that is in our working note number 1, 310 revenue is 310,000, 310 million. Then we go to the cost of sale, 243,180. If we do this, we are getting the gross profit as, let us calculate the gross profit. If we do this, we are getting the gross profit as 66,820. 66,820. Then we go to the expenses. Under the expenses, we have the distribution costs. The distribution cost, we just take it directly from the trial balance. The distribution cost from the trial balance is 12 million. 12 million. We have the administration cost. The administration cost from our working note number 3. It is 24,400. 24,400,000. Then we have the discount allowed on trade receivable. That is 2 million from working note number 8. 2 million. Discount allowed is an expense. Then we have the finance cost in our working note number 4. Finance cost is 5,650,000. 5,650,000. So we get the total expenses. We add this to get the total expenses. I'm getting, if I add this, I'm getting the total expenses as 44,050,000. I deduct the expenses from the gross profit to get the profit before tax. So I'm getting my profit before tax as 22,770,000. 22,770,000. Then I go to the income tax expense in working note number 7. Working note number 7. Income tax expense is 5,200,000. $5,200,000. Therefore, our profit after tax, our profit after tax is 17,570,000. Then we deduct the ordinary dividend paid. The ordinary dividend paid from the trial balance. The ordinary dividend paid is 30 million. So we deduct 30 million. 30 million. And then we add the retained earnings brought down. That is the retained earning at the beginning of the year from the trial balance. The retained earning at the beginning of the year. The retained earning were 43 million. So we add 43 million. Therefore, the retained earnings carried down, that is the retained earning at the end of the year. If we do this computation, I'm getting 30,570,000. 30,570,000. I'm done with the statement of comprehensive income, and therefore I'm going directly to the statement of financial position. Statement of financial position. I can start with the property, plant, and equipment in our working note number 8. Property, plant, and equipment. We got 136 for 20. 136 for 20. 136 for 20. Then we have the wrist machines. The wrist machines, that is from our working note number 4. The wrist machine is 52,500. 52,500. Therefore, the total of the non-current asset, is 188,920. 188,920. We now go to the current asset. Another current asset, I start with the inventory. Inventory in the working note number 2, we got the inventory as 39,900. Then the trade receivable in our working note number 10 is 48,000. Then cash and cash equivalent, that is from the trial balance. Cash and cash equivalent 24,800. Then we have the prepaid rental on contract, that is 600. Prepaid rent on contract A 600. Then we have the interest receivable. Interest receivable on the trade receivable in our working note number 10, that is 800. 800. And if we add all of this, I'm getting 100 as the total of the current asset. So we add current asset to the non-current asset to get the total of the assets. So the total of the asset, I'm getting 303,020. That is 303,020,000. Then we go to the financed by, this is the part of equity and liabilities. Equity and liabilities. We start with the equity and liabilities. We start with ordinary share capital from the trial balance. Ordinary share capital from the trial balance is how much? The ordinary share capital from the trial balance is 154 million. $154 million. Then the revaluation we have calculated, this is 15 million. The revaluation reserve. Then we go to the retained earnings from the statement of comprehensive income is 30,570. So the total under the equity section is 199,570. 199,570. Then we go to the long-term liability. We are supposed to start with the long-term liability. We're supposed to start with the long-term liability. Under the long-term liability, we have the finance risk. That is under the finance risk. That is the contract B working for, which we got as 55,650. 55,650. Then we have the deferred tax, which we got as 7,800,000. So if we add this, we are getting the total of the long-term liability as 63 and 63 for 50. 63 for 50. Then we finally go to the current liabilities. Finally go to the current liabilities. We start with the trade payables. The trade payables from the trial balance is 30 million. Then the tax payable, that is the estimated tax, that's 5 million. And then the customer deposit in the was 5 million. If we add these, we are getting the total of current liabilities as 40 million. We are getting the total of current liabilities as 40 million. So we get the total of equity and liabilities. Get the total of equity and liabilities, that is 199,570 plus 63,450 plus 40 million. And if we do this, I'm getting 303,020. 303,020. And as you can see, our statement of financial position has balanced. And therefore, if you have any question, you can post it in the comment section below. Remember, we have prepared the question for financial reporting, the past paper. We have prepared all the answers. They have been peer reviewed, and if you want them, you can follow the link in the comment section, and they are at a cost of 300 only. 300 shillings only. Therefore, thank you very much. Thank you very much.